Hello, welcome. I see a lot of familiar faces. Good to see you all. Welcome to the Hutchins Center conference on what happened in the repo market, why, and should something be done about it. I'm going to start us off today, and then there will be a number of expert panelists to discuss these specific questions. The rising volatility in the market for short-term collateralized borrowing, known as the repo market, punctuated with a rate spike in September, has drawn public attention to a market usually of concern only to money market participants. The volatility reflects the confluence of significant changes in the financial system since the financial crisis. It reflects changes in the Federal Reserve's monetary operating framework and in bank regulation and supervision. It also may reflect changes in attitudes towards daylight overdrafts and discount window borrowing, and changes in the market structure of the financial system. The September episode catalyzed interest in looking at the interactions of these different policies and assessing what is working well and what isn't. Before we rush to changes, however, we need to better understand what happened and why, and that's the goal of this event today. So why do we care about what happened in the repo market? Repo, as you know, is a critical element of the plumbing of the financial system. It is used, for example, by dealers to finance U.S. Treasury securities and by money market funds to invest cash with safe collateral. It supports the primary securities markets and secondary market liquidity. What happens in the repo market can influence other money market rates, including the federal funds rate, which is the target rate for monetary policy. But periodic episodes of volatility in the repo market do not necessarily indicate significant problems in the financial system, though they are definitely worth studying given the important role of repo in the financial system. In the past couple of years, increases in repo rates at month-end and quarter ends have become more pronounced as the Fed began to shrink its balance sheet and reserves continued to fall. These increases are reminiscent of the money markets before the crisis, when the Fed operated in a scarce reserves framework, but which basically disappeared with the Fed's new ample reserves approach. But on September 17th, although cash scarcity was predictable, given scheduled corporate tax payments and Treasury settlements, the spike in repo rates was big and took many by surprise. The Fed funds rate moved above its target range. The Fed responded by adding reserves, and money market rates stabilized quickly in the following days. Still, the event raised questions about the ability of the Fed to control the policy rate in an abundant reserves framework. It also led to questions about the demand for reserves and the willingness of banks and dealers to arbitrage in the money markets, which reduces rate volatility. We plan to discuss today what happened, the key policy objectives to keep in mind when considering any changes, and the pros and cons of some possible changes. In particular, given the revealed preference for reserves and what appears to be a steep slope for the demand curve, our two broad and interrelated questions are: would a larger Fed balance sheet with more reserves in the banking system solve the problem without creating others? And should the Fed create a standing repo facility to supply cash when others won't? And second, are there regulations and supervisory practices that are reducing the incentives or the ability of players to lend cash when interest rates spike? And are there changes to regulations and practices that could reduce unwelcome market volatility without risking safety and soundness and overall financial stability? So we'll begin today with two presentations on what happened. First, Trish Mosser, now at Columbia University, formerly deputy manager at the desk at the New York Fed, and then Jerome Schneider, head of short-term portfolio management at PIMCO. They will be followed by former Fed Governor Dan Tarullo on policymaker objectives. Then my colleague David Wessel will join the three of them on stage, and we'll turn to further discussion and field your questions. After a short break, we'll come back, we'll turn to a closer examination of the Fed's operating framework and the role of financial regulations. For those of you who are watching online, you can submit questions, and you can submit them by email to Hutchins Center, one word, at brookings.edu, or at Twitter at #repo_marker. So with that, I'm going to turn this to Trish Mosser, and thank you all for coming.
Thank you very much, Nellie. Good afternoon, everybody. Before leaping into what happened in money markets in mid-September, let me start with a couple of points of background for everybody here and online. And I know many people in this room already know this, so I hope you'll just bear with me for a couple of minutes. First background piece, a few words about U.S. money markets. They are short-term lending, if you like, short-term debt markets, used by a wide array of financial institutions and investors and large non-financial companies as well as by the U.S. government and agencies. In maturity, they range from overnight to up to a year, although predominantly they tend to be less than 6 months in maturity. They come in lots of types: commercial paper, tradable bank deposits, treasury bills, I could go on. But for the purposes of today's discussion, we're going to focus largely on the federal funds market and the repo market. The Fed funds market is a short-term lending and borrowing, if you like, between banks and the GSEs. We're going to focus mainly on banks, but the GSEs are also part of the market. Like many other money markets, Fed funds are unsecured, meaning they're promissory notes, effectively. And of course, the Fed funds market also matters because it is, as Nellie pointed out, the market whose interest rate the Fed targets for monetary policy. In contrast, the repo market is used by many, many different types of firms, and it is literally an order of magnitude larger. In addition, it is collateralized, meaning that a lender only provides a short-term loan if a borrower provides collateral, some sort of a long-term security, most commonly U.S. Treasuries and U.S. mortgage-backed securities, agency mortgage-backed securities. Interest rates in money markets do tend to move together. They don't track each other exactly, but they do, for many, many decades, tend to move together over time. In part because it's been relatively easy, at least historically, for participants to move back and forth, lending and borrowing, and even to arbitrage in the market. Of course, another important historical link between the two markets is that the Fed, like many central banks, while it seeks to influence the federal funds rate, actually conducts its borrowing and lending operations in repo markets. That's actually fairly common. So, second background point. One of the consequences of the Fed's very large asset purchase programs, or QE as we all call it, was an equally vast increase in the supply of reserves in total that the banking system had to hold. Here's a picture of the Fed's balance sheet. The assets are on top in blue. The liabilities are on the bottom in orange. And you can see both the size of the QE as well as the equal growth in liabilities on the bottom. The orange section is reserves. Because the supply of reserves was so vast, it was for many years substantially larger than the demand for reserves, even when market interest rates were very close to zero. So supply is systematically above demand. And by the way, that means that the actual trading in the federal funds market has been a shadow of its former self. There's still trading, but much, much less than it was in previous years. Obviously, when the Fed finished QE and was determining whether to shrink its balance sheet, they viewed that as a long-term process, and so they decided to run monetary policy with this strange supply-demand imbalance in the reserves market. So supply, in fact, they designed their regime around that. I think Bill English is going to say a few words about that later on. So with supply sort of permanently above demand at the current market rate. And given that they were going to run monetary policy with a very large balance sheet for the foreseeable future. So they wanted demand bigger than supply within the operating framework. But here's the quandary. The Fed did shrink its balance sheet. Reserves were shrinking for other reasons as well. So at some point, demand was going to get close to supply, and close to the point where reserves would all of a sudden become interest sensitive again. At what level of reserves was that? To the Fed's credit, they were very clear that they didn't know where that level was, but they were going to try to stay away from it if possible. And in fact, there were a number of surveys or estimates, and then the numbers ranged from $1 trillion to a bit more than that as time went on. So what happened in September? Well, everybody found the downward sloping part of the demand curve for reserves, is the short answer. And it was at a substantially higher level of reserves than many had expected. And the immediate impact of that, of course, was that interest rates became immediately sensitive to Fed funds rate. This is a picture of the repo rate in red, the actual federal funds rate in green, and the target range for the federal fund rates are the yellow boxes up there, going back several years. And you can obviously see what happened in mid-September. Now, the proximate cause of, or maybe a better way to put it would be to say the trigger of the events in September and the hiccup, if you like, were very large shifts in a kind of obscure part of the Fed's balance sheet that caused a sudden very large drop in the supply of reserves and probably also increased the demand for reserves at the same time. First, on September 16th, U.S. Treasury had some very big corporate tax receipts plus settlement of a relatively large Treasury auction. And when the private sector decided to pay their tax bills and for their Treasury investments, banks effectively shifted reserves out of their accounts and into the U.S. Treasury account at the Fed. This is a kind of complicated table, but I want you to focus on the two columns that are labeled September 11th and September 18th. The Fed does not publish its balance sheet every day. They only do it weekly. There's a little history on the left if you're interested, but I want to focus on the two columns in the middle, the third and the fourth. You can see what happened in the U.S. Treasury account. Basically, within a day, $150 billion shifted out of reserves and into the U.S. Treasury account because of those events I just talked about. Now, this is weekly data, so the number is only $120 billion because there were some offsets in the intervening days. But you get the idea that it was a very large number, even for a central bank with a big balance sheet. In addition, the other line down here in the obscure part of the Fed's liabilities is the reverse RP pool, which is largely, by the way, reverse repurchase agreements or the Fed lending, but mostly from foreign official institutions, meaning other central banks and so forth, and doing repo with them. That went up during the same week by $40 billion. So the combination of those both directly reduced reserves and created if you like, the drop in the supply of reserves. Now, in response to the market kerfluffle, as someone said earlier today, the Fed, as Nellie noted, immediately added reserves the next day. They increased the supply of reserves, not by buying assets, but by actually engaging in repo operations, meaning lending effectively to the core financial intermediaries. In fact, they did that to the tune within a couple of days of $75 billion. Which is the circled white part up here. So repos, which had been absolutely zero, obviously all the time that QE was in place, all of a sudden became significant almost right away. In subsequent weeks, the Fed continued to lend out more repo, some of it at longer term, and they also started buying assets, specifically, but not long-term assets that they had during QE, but short-term Treasury bill assets, specifically to raise the supply of reserves. The last column here is the current balance sheet, as of last week, I should say. You can see that the repo pool is now nearly $200 billion in lending they're doing, and on top of it, they have increased short-term treasuries by $140 billion. So the Fed's overall balance sheet, looking at the assets on the top line, has gone back over $4 trillion, and the amount of reserves in the system, reserves are down here, are back up over $1.5 trillion, almost $1.6 trillion in point of fact. So that's what happened. Kind of technical. That's a technical story. But the underlying drivers of what happened are much, much more complicated, and that's what the rest of today is about. I'm going to give you my little short list of contributing factors. Other speakers are going to expand on that, I know. First of all, the post-crisis regulatory regime clearly has a role to play here. One reason that nobody knew where the demand curve for reserves was, in addition to the fact they hadn't seen it in 10 years, is because during the time of QE and the huge balance sheets, the entire global financial framework around liquidity, counterparty risk, and capital had been completely redone, and for very good reasons. And I want to be very clear here, this is not just about bank regulations and things like the LCR and leverage ratios and liquidity planning for resolution. The structural and regulatory changes for money market funds, in repo markets, in derivatives, even in securitizations, which impacted other money markets, they have all had an impact in the way U.S. money markets function. So this is not a simple thing, it's all about the banks. A second reason, second factor I should say, inexperience in money markets that actually function normally, meaning with a little volatility. Back in the day, as they say, meaning for many years before the financial crisis, money market interest rates broadly moved together, not in unison, but together. There was volatility, and sometimes there were even spikes in rates. And those were the days where, A, the Fed was working every day. They did repo operations every day to try to keep the Fed funds rate stable. And not only that, there was active arbitrage on the part of the private sector across different types of money markets. The Fed did not smooth out everything in those days. And they were not expected to smooth out everything in those days. Let me give you an example. The top is repo, Fed funds, and the target ranges again, but this is just for 2019, so it's just for this year. On the bottom, I have exactly the same interest money market rates and the target rate and the same colors, but the year is 2005, so 2 years before the financial crisis. The first thing I want to point out to you is how much all these money market rates bounce around. And not only that, they spike sometimes. I have a few vivid memories of the federal funds rate closing at 11 and 12% at 5%, at 5 o'clock on a few days. So volatility, periodic volatility that no one could quite manage is common in money markets and completely normal. A corollary to that, of course, is that there hasn't been actually very active arbitrage in money markets for 12 years. Nobody knows how to do it. The rules of the game have all changed, particularly the regulatory rules. And let me be clear here, I'm not talking again just about the biggest banks, but the entire set of companies who actually function who actually use these markets. A final complicating factor I want to point out too, and this has to do strictly with the repo market. Repo is collateralized. If there are very large changes in the quantity of collateral, and here I'm thinking U.S. Treasuries, that can actually impact repo rates. And in point of fact, ever since the U.S. deficits got big, starting in 2018, repo rates, you'll notice in the top chart up here, have actually popped up more than they did back in history before. Sorry. Let me go back to this one. That's not an accident. Lots of extra supply of collateral means lots of people would really like to borrow against it, but there's an excess demand for borrowing, so rates go up. We're going to have big deficits and continued very high Treasury supply for the foreseeable future, as far as I can determine. So I wouldn't expect that this is going to be something that goes away. In short, this fall, the financial system has been relearning how to function in what I'll put in quotes as normal money markets, meaning volatility that the central bank doesn't completely preempt and offset, but with a really, really different regulatory regime. This is actually an opportunity to do some learning and to learn about what it is that is making money markets volatile in different ways. And I think a certain amount of learning by everybody might not hurt so much, and it might cause a nice side effect of that might be just a little less hysteria too. So thank you all.
Thank you and good afternoon. Thank you to the Hutchins Center and and Brookings to hold this and to bring some light to a part of the market that only seems to be thought about during times of stress or crisis. And quite honestly, as a practitioner and manager of capital on behalf of clients, this market is of concern. It has raised a lot of awareness and issues, and probably for the first time since the financial crisis is back at the forefront of a lot of discussion. So it's poignant that we're sitting here today discussing this and really bringing light to the fact that the repo markets are an effective way to, number one, obviously to transact and conduct monetary policy, but more importantly, it's a rational indicator of what the cost of capital is. And one of the things that you have to think about as a practitioner of capital is how that gets transmitted through the monetary system in a variety of ways. So for us, looking at the repo markets is not only a great barometer of the overall health of the market, as you see it transform from balance sheets of money center banks to the private sector and beyond, but really to thinking about how leverage and cost of capital is really managed. To that end, it's important to highlight what happened, obviously, back in September, but also highlight how the repo markets function and ultimately where we should be thinking about this in the construction of an evolving system of monetary policy. Number one, just to highlight, as Trish mentioned, there's three things that basically a trifecta of circumstances that happened back in September. The corporate tax day reduced a lot of excess liquidity within the system. That's one clear cause. Number two, an increased amount of collateral which needed to be financed, and as we've also highlighted here, that's going to be a continuing need. So as deficits increase, the continuing demands on financing collateral through primary dealers on those settlement dates is going to be a known at that point in time, but something that's going to have to be dealt with at that point in time. And then the third one is clearly the rebuilding of the cash position of the Treasury, which all led to a consequential deficit in excess reserves in the system that day, or at least perceived that day. Let's put it in context, though. We have had 8 times over the course of 2018 and 19 where we've actually had reserve changes of greater amounts than what we had in September, in that mid-September date, meaning that the demand decline in reserves was actually greater than what we witnessed. So why did it happen that date? What happened? Well, obviously, the elasticity or inelasticity of moving the reserves in the system has changed. And that's really what we need to be focused on, is how the transmission mechanism gets permeated through the system at that point in time. So it wasn't anything extraordinary. And more importantly, Treasury settlements happen all the time, and demands of financing happen on a regularly scheduled basis. They're known. That's a fact of the market. And actually, we see spikes in repo rates happen on a frequent basis. When I see spikes, 5 to 10 basis points for a few $billion is something that is consequential as a practitioner in the marketplace, but not necessarily of concern. When we think about this, what's clearly happened is that there's become dealer balance sheet inelasticity. And when you combine that with the general opacity within the financial community and really the primary dealer community about how much balance sheet is being allocated to repo, it creates a bit of a illogical discussion of what is the proper rate where repo rate should trade. It's been that way not just for the past 3 months, but really the past 25 years, that there is an equation which dealers may or may not participate in providing the incremental dollar of funding. And I think what we're finding now is that when you combine that with monetary policy and a reduced state of excess reserves or a declining state of excess reserves, it actually creates a little bit more volatility in the market. The question is that volatility bad? And more importantly, is it abnormal? Probably not. And I think that one of the cases that we have to consider today is the fact that we've been relatively subdued in the volatility in the money markets, and we've become accustomed to the fact that there has been basically no volatility in money market rates, including repo rates, for quite some time. But that's not necessarily normal. So adjusting our expectations and adjusting policies to accommodate that rationality is something that we have to do as investors and practitioners within the market, combined with policy and regulatory frameworks. So to even money market participants like myself, some of these situations that were occurring in September were a little bit more opaque in terms of how we approached it. Similar situations don't necessarily lead to the same outcomes over that period of time. All we see is that where those markets price in real time and try to react accordingly. So at PIMCO, we clearly are thinking about this on a proactive basis, being defensive in terms of managing liquidity, having frameworks which help to gauge and sort of be proactive about how to manage liquidity within changing rates and rate conditions. But not everybody has that capability. And what we saw back in September was that incremental buyer or the incremental borrower of liquidity simply didn't have that degree of freedom that other institutional investors or even retail investors might have at that point in time to take advantage of it. So fundamentally, what we have to do is overcome that inelasticity that I referred to a moment ago and think about how dealer balance sheets can become resilient and more importantly, try to quantify better how balance sheets from those banks, et cetera, are utilized to fund the repo market, especially given higher collateral management and higher collateral needs. So this leaves us where we basically are today. Post-crisis regulation has been impacting the money markets. We've seen it through money market reform. We've seen it through more technical markets like cross-currency basis, where we've seen stresses from time to time. And it can happen for a variety of reasons, and it can be permeating different segments of the market, but it may not. And what we saw in September was clearly it was a pretty defined impact to just the repo markets at that point in time, which actually should be alleviating a lot of broader market concerns. Fundamentally, this isn't a 2008, and that's the number one question we have been talking with clients about. It's not a structural breakage, it's not a counterparty credit risk, so it's fundamentally different in that regard. But what it is a recognition that the cost of funding, the cost of liquidity is a dynamic, and more importantly, can rapidly change given certain circumstances in time. So what is the role of the Fed? Ultimately, the role of the Fed needs to be thinking about how it can be the lender of last resort at that point in time. Perhaps it's a standing repo facility. Perhaps it's some regulatory relief in the future, how to manage CLAR. But we need to be thinking about how ultimately the banks should be reacting to this and how they could be potentially a beneficiary to the broader marketplace. Context is important. So while 7% or 10% repo rates aren't necessarily ideal, it wasn't destructive to the market long term. The Fed obviously responded to that. But what we are seeing is that banks are being regulated into an unstable equilibrium, meaning oftentimes their degrees of freedom are being curtailed in a lot of ways, which don't necessarily mean for a smooth pricing of overnight repo and zero volatility in the marketplace. Again, something that we should be growing increasingly comfortable with is some modest volatility within the marketplace. Pro-cyclicality in the post-banking crisis has led to some of this, but we really need to be thinking about is not the primary order impacts of what's going on in the marketplace, but the second order impacts of what regards to regulations, of how those regulations are having on non-bank participants in the market. So the primary dealers have their equation, but it's the secondary participants who may or may not be impacted by those higher rates to come. So in short, what we saw back in September was not a shortage of cash or primary liquidity, but it was a shortage of cash to their internal liquidity buffers of those primary dealers, of those GSIBs, above their CLAR requirements. So the buffers on buffers are what actually matter at that point in time. The other aspect to think about is simply a little bit of complacency. At PIMCO, we've been tracking the decline of excess reserves as much as anybody has, and yet we still didn't expect the impact on the September hike or the September settlement date. But what we do see, and we have been thinking about, is how to be more dynamic in terms of approaching liquidity management. So given the current market environment, it is an ideal time to reflect, as we are here today, to the overall environment, and more importantly, think about ways to actively manage liquidity in the context of a slightly more volatile liquidity and funding cost environment for repo at that point in time. So the consequence is that a large portion of the market simply doesn't understand how their primary funding counterparties and primary funding partners operate. It's going to simply mean that they're going to be carrying a certain amount of higher prudential risk than throughout the cycle of the economic cycle than might be prudent, and should cause a bit of hesitation and at least reflection about how to more dynamically approach liquidity management and, frankly, higher cost of capital or changing cost of capital as transmitted through the repo markets. So investors should look to be cognizant of those leverage points. They should be thinking about repo as an indicator of the ultimate cost of capital, and more importantly, secure term funding and ways to mitigate funding risk so they aren't caught off sides of those points in time. And ultimately, that will lead us to take what's happened in September and make it more of a lesson-oriented experience at that point in time. Thank you very much.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.